With excessive money printing continuing and inflation starting to bite, what does this mean for the mining industry? In this video, we get an opportunity to investigate the supply side pressures that could point to a sustained bull market in precious metals, as I interviewed David Garofalo, the ex-CEO of Goldcorp, who presided over that company's $32 billion merger with Newmont Mining. And remember, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how you can invest and store physical gold and silver, visit goldcore.com, your precious metal specialists. David, welcome to GoldCore TV.
Thanks for having me on, Dave.
Now, it's great for a change. It's fairly refreshing for us to have somebody on the supply side in the gold industry. But to just set the tone, can you describe the state of the precious metals mining industry at this moment in time?
Well, I'd say it's mixed. I mean, from a financial perspective, we've never been healthier on the operations side. We've spent the last half a dozen years or so harvesting our existing assets to great effect. We've had expanding margins as the gold price has gone up. We've generated increasing free cash flow. We've paid dividends. We've paid down debt. For the first time in my 30-odd year career in the mining business, the industry is at net zero debt. So the balance sheets have never been stronger. Where we're weak, unfortunately, is in our underlying asset base. We've seen a steady depletion of reserves. They're down 40% from the peak 6-7 years ago. And that means that average reserve life has gone from about 20 years to 10 years. And that's an existential crisis because from discovery to first production, it takes a minimum of 10, sometimes 15, 20 years to get first production.
Wow. So when you talk about reserves, you mean actually metal in the ground. That's exactly discovered right. Metal in the ground.
The ounces we have in the ground yet to be mined. And so we're down to effectively 10 years of reserve life. That seems like a long time, but it isn't given the long lead times from discovery to production. So we are dealing with necessity to invest back into the ground, both in exploration and development. That's been largely absent from the industry because when we experienced the last peak gold cycle about 10 years ago, post the credit crisis, when gold last went through $1,900 an ounce, the industry strapped on a lot of debt in investing in new production capacity. And the investment community said, well, enough's enough. Your costs of inflation are inflated out of control. You have to start to harvest returns from your existing asset base. And so really there's a building strike, if you will, over the last 6 or 7 years, while the companies focus on improving their balance sheets and generating reasonable returns and paying dividends to shareholders. So they started to run their businesses as businesses, but we're not businesses in the traditional sense in that our asset base is always depleting. Every day that we mine an ounce of gold, we die a little bit unless we're investing back in exploration and development. And we simply haven't been doing that. And the junior part of our sector, which conducts a lot of the grassroots exploration, until recently couldn't raise money to save their lives. And so as a result, there hasn't been that investment in exploration that the industry needs to populate their pipelines.
And what impact did COVID-19 then have on the discovery and the production process?
Well, I think it was disruptive to a lot of industries, but by and large, the mining industry came out of it relatively unscathed. So we were able to still produce gold at reasonable costs and still had a very profitable year, even during the COVID pandemic. There were isolated instances of disruptions in production for a period of time. And exploration activity actually picked up over the course of the pandemic. A lot of that is not terribly labor intensive. You have a few drillers on site and you're able to still conduct the grassroots exploration. And the juniors actually saw a pickup in investment. We saw juniors start to raise money from traditional sources of capital, the equity capital markets, for the first time in a long, long time. But I'd say somewhat selectively. Not every junior could raise money. I think some of the better stories could do so. But it hasn't been a wholesale buying into the market. There hasn't been an influx of a lot of generalist capital into the junior cycle in the junior sector, that you've seen in past cycles. So we're still not seeing a wholesale investment in the gold industry that's really required to reintroduce exploration to replace depleting reserves.
So, what are the major supply side issues then in the industry, apart from the reserves? I mean, in terms of we're seeing an uptick in inflation. We've seen the second month now in a row of higher than expected inflation. We've also seen oil touch off $70 a barrel, and it looks like and feels like it's going to go higher as well. How do these things impact the mining industry? And is there anything else on the supply side then that you're keenly aware of?
Yeah, no, those are absolutely excellent points because we've had relatively stable cost structures for the last 6 or 7 years because energy prices have been relatively muted, if not depressed. And so that's been a big driver of cost stability. Also, we've seen local currencies that have been weak against the US dollar. So we often mine in emerging economies. And so those currencies, those weakening currencies have helped maintain low local cost structures. But that's reversing itself. We're starting to see energy prices pick up. We're starting to see local currency strengthen against the US dollar. So where we had tailwinds, we're going to start to experience headwinds in terms of our cost structures. And the other thing is we are starting to see, as you correctly pointed out, inflation rear its ugly head again in the general economy. And the fact that we've underinvested in exploration and development means that there's going to be a wall of capital that will have to be invested into exploration development in the coming years. We're going to repeat the mistakes that we made 10 years ago as an industry. We're going to overcompensate the lack of investment in exploration development, and we're going to drive cost inflation dramatically because the reality is whether you're in base or precious metals, and we're seeing copper at all-time highs, and so we're at incentive levels for copper development, we're going to see a significant influx of capital both on the base and precious side. And we're using the same resources to build copper mines that we're using to build gold mines. It's the same engineers and geologists and metallurgists, and the equipment is the same. Mining is mining at the end of the day. And so I think you're going to see a coordinated reinvestment back in exploration and development, both on the base and precious side. And I think we're going to face hyperinflation in the mining industry again. And it's going to start to undermine returns. It's going to start to reintroduce leverage onto the balance sheets. We frankly haven't learned from past cycles.
So hyperinflation on the cost basis.
Exactly. Yeah.
Right.
We're going to see that in the general economy. And the reality is, we are seeing higher general CPI numbers. Recently, I think the most recent US CPI number was over 4%. I think there's another number coming out this morning that I haven't seen yet, but that sounds like a high number relative to where we've been historically in the last 6 or 7 years. But the reality is inflation's well above that. If you've tried to buy a house in the last year, it's not 4% inflation. It's well north of that. We're seeing inflation in all of our input costs well north of where the headline numbers are. And so we are in a hyperinflationary cycle, given the debasement of fiat currencies that occurred over the last several years. And that's going to drive cost structures up generally. But the fact that we have to overcompensate and invest in new capacity in the mining industry, both in base and precious side, will only hasten that inflation for the industry.
Hey, touch on base metals there. Obviously, we've seen significant appreciation in the price of base metals also. Silver is generally mined in the most instances as a byproduct of mining base metals. Does the rally in base metals affect then the ability now to mine silver?
Well, I think it should help supply if we start to see a significant investment back into the base metal sector. But the reality is, even if some major investment decisions were made in the copper side or zinc side, for example, we're not going to see the evidence of that in silver supply for a number of years. The lead times are still quite long. The capital intensity is very high. Getting a social license to actually build new mines takes time. We're not going to see a supply pick up in a meaningful way, in my view, on the silver side. I would make a strong case for silver demand. I think silver is bought as a proxy for gold quite often. It's seen as kind of poor man's gold, if you will. So if you're a believer in the precious metal cycle, the potential for silver to outperform is significant because typically the gold to silver price ratio in a bull market can be as low as 30 or 40 to 1. And we're well north of that now. Silver's underperformed, but it has the ability and capacity to significantly outperform gold in a rallying gold environment.
And do you see constraints in the supply demand then in silver being greater than in gold?
I'd say it's less to do with supply constraints and more to do with a demand-driven market. And I'd say that's true for gold. There is no lack of supply for gold. For example, there's over 100,000 metric tons of gold sitting in central bank vaults. I mean, there isn't a lack of supply. It's always been a demand-driven market, and what drives gold upwards, it's a currency, not a commodity. In my view, is relative interest rates. Gold yields zero, but sovereign debt now yields negative. And so there's an opportunity cost to owning gold. And silver is seen as a proxy for gold. It doesn't have the reserve currency cachet that gold does, but people, again, trade silver as a proxy for gold and try to play that arbitrage that you see in the gold to silver price ratio that quite often occurs in a bull run.
You were the CEO of Goldcorp for many years. If you were still CEO of a large mining company, what would be the one thing that would give you sleepless nights in this environment?
Yeah, lack of reserves. And frankly, that's what drove us into a merger with Newmont back in 2019 and then drove, but just before us, Barrick and Durangold's arms, is that there was a lack of growth in reserves. There was, in the case of all four companies, an impending cliff in production because of reserve shrinkage that we've had. And so we all ran into each other's arms to maintain a stable reserve profile and stable production profile and deal with the lack of growth that we had individually. And that allowed us to focus on a nucleus or a core within each of our portfolios and divest of non-core assets that didn't meet our quality criteria. And as a result, both companies, both Barrick and Newmont, post the merger, realized a significant re-rate in the market because it really reduced the risk profile, maintained a stable production profile, stable reserve profile, and improved the quality of the overall portfolio. And so I would say, as a result, you're going to see that kind of dynamic down to the next tier among the mid-tier and the emerging producers. You're going to see companies run into each other's arms to deal with their depleting reserve and production bases and to achieve some critical mass and liquidity in the market, because as generalist investors come into the sector, they're going to be looking for liquidity in names. Initially, they'll buy the seniors, but if they're looking for more leverage, they'll want to buy the next tier down, and they'll get that leverage to the gold price in that tier, but they'll want liquidity. They want the ability to be able to get into names and get out of the names very readily. And so achieving scale, I think, achieves that objective.
So you think we're going to see a raft of mergers then and acquisitions over the next coming years if this environment continues and the problem with reserves continues?
We're already on track to achieve a record in terms of mergers and acquisitions. And that's even in the pandemic environment we find ourselves in, where you can't physically do due diligence on each other's assets, or couldn't up until this point. As travel restrictions start to slacken, I think you're going to see a significant pickup in due diligence activity and ultimately into mergers and acquisitions. So I think we're going to have a record year, but it's not going to be driven by a couple of large deals like it was in 2019 when we last had a record where Barrick and Randgold merged, and then Newmont and Goldcorp achieved a $32 billion merger at that time. We're going to see a significant pickup in volume of deals, which ultimately will give us a bigger dollar number than we saw in 2019, but it's going to be made up of more players.
More smaller players. Now, when you talked about reserves there, and you talked about the shortening of the kind of the reserve life from 20 down to 10 years, obviously there is a need for gold miners and silver miners to hedge their future production. How exactly, can you explain how generally you would interact with the futures market or with the refiners in that capacity to hedge your future production?
Well, I have to tell you that generally speaking, in the gold industry now, that hedging is verboten. It's seen as diminishing the leverage proposition that investors are looking for in gold stocks, undermining that. That being
because
said,
they want greater exposure to an appreciating gold price. Is that it, or silver price?
Absolutely correct. And I think that there's less of an imperative to do that type of hedging, given how healthy balance sheets are in the industry. As I said, we're at effectively net zero debt, so there isn't this drive to protect balance sheets by hedging gold. That being said, I think as you start to see more capacity built up, more new mines put into development, particularly among the emerging producer class, and they want to access the debt markets, bank lending and whatnot, from time to time to fund project development, you may see some gold hedging, some limited gold hedging to do that, because lenders will demand that they have some price protection during the loan life. But I would say a wholesale transition into hedging among the producer class is very, very unlikely. The other thing that I think makes it unlikely is the fact that there really is no contango in the gold market right now, given how low interest rates are. We don't see a steep forward curve. So there isn't an economic incentive to drive producers into large and wholesale hedging of their gold price.
So would it be a case that if we have a little bit of volatility in the gold price and it falls from where it is now, that miners will sit on what they have produced for a better price, or what's the decision-making process?
That would be the economically rational thing to do, but I've rarely seen that happen.
Okay.
Because generally you built this infrastructure, you spent hundreds of millions and sometimes billions of dollars to build up this infrastructure, and you're dealing with increasingly lower grades of deposits. So you require the economies of scale. You have to keep those plants full in order to achieve the economies of scale and keep your cost structure stable. So the reality is extremely rare to see producers kind of sit on their hands when they've already got that productive capacity available.
Like any other business, they need the cash flow.
Exactly. Yeah.
So the hedging capacity or the hedging activities as such has probably moved away from the mining sector and is more concentrated then in the refining sector, who have to kind of guarantee their purchase and sale price. Would that be fair to say?
And they've always done that on the refining side. They never really take price exposure. They're making their margin on the actual refining activity. So they hedge it coming in, hedge it coming out to ensure they don't have that metal price exposure over the period they're refining the metal.
And more of a macro question, are you bullish on precious metals?
I am, for the simple reason that we've seen exceedingly low interest rates for a long period of time, and we're likely to continue to see that. I think we've seen a coordinated effort among central banks to debase their currencies, to preserve their export markets, but also to inflate their way out of debt. The debt levels that have been strapped on by governments globally, particularly industrialized world, simply it's fiscally impossible to repay them, So the only way to deal with that debt is effectively inflate their way out of debt. I think every central bank understands that. And what we're seeing in quantitative easing is that kind of inflationary cycle that will underpin gold for the foreseeable future. I don't see that reversing anytime soon. I don't see interest rates going up appreciably anytime soon. I think we're going to go into a hyperinflationary environment. And the last time we really actually experienced this was probably in the late 70s and early 80s. And that's when gold achieved at the time a nominal peak of about $850 an ounce then in 1981. And today's dollars, that's close to $3,000 an ounce. We're not even close to the cyclical real high for gold. And I think there's no reason we wouldn't achieve that in this cycle, given the coordinated effort to inflate the economies globally.
So on that basis, you're not buying the Fed speak of transitory inflation?
No. I mean, as I said, anybody trying to buy a house, experiencing fuel price inflation, energy inflation generally, anybody just buying a basket of goods knows that inflation is not 4%. It's not 2%. It's in double digit territory already. The necessities of life have inflated dramatically. There's an increasing, almost exponential increase in paper currency, chasing finite amount of hard assets. And so we're seeing that. And we're seeing evidence of that kind of inflationary mindset in things like cryptocurrency. Among a new class of investors, there's this perception of scarcity in cryptocurrency. And that's why intuitively, these new class of investors are buying the cryptocurrencies. The reality is there is no scarcity in cryptocurrencies. Anybody can introduce a cryptocurrency into the market, which undermines that scarcity. In fact, central banks are talking about digitizing their currency. So they're going to try to capture the market share there. Once they start doing that, cryptocurrency becomes a fiat currency like the paper that's already out there. And gold ultimately is the only currency you can't print. There's such a finite quantity of it, and it's so difficult to increase supply. In fact, there's a remarkable inelasticity of supply to price. Supply is going down today, even as the gold price goes up.
Do you think that cryptocurrencies have been eating gold's lunch over the last while?
Absolutely, yeah, for sure. Because as I said, this new class of investor, instinctively understands that their fiat currencies are being undermined, and they're saying, "Oh, well, I understand digital. I understand digital currencies. I get it. I understand the concept. So I'll buy it and try to protect my capital." And so they have stolen some of the market share that gold should be capturing. But we're seeing a deflation in that trade right now. We're seeing some of the fear come out of it, and gold is recapturing market share because it truly is a scarce currency, and actually has physical characteristics, unlike cryptocurrencies.
And do you see it coming more mainstream as an investment than it has been in the past? I know, for example, there's the subreddit Wall Street Silver now has over 100,000 members on it, and it's growing all the time. There seems to be a new generation of investors that's looking at gold and silver for the first time in a lot of instances, probably or most definitely fueled by this inflation discussion.
Absolutely. And what's encouraging to me is there are many, many more ways to play the gold market than there were available, 20, 30 years ago when I first started in the industry. I mean, if you physically wanted to own gold, you lined up at a bank with your driver's license and passport, and you bought your gold, and then you had to find a place to store it. And so there was a lot of friction. Transactional friction in buying gold. Then there was the advent of the ETF about 15 years ago, GLD on the New York Stock Exchange. There's a silver equivalent as well. Mm-hmm. So you're able to actually physically own gold through, a recognized symbol on the New York Stock Exchange. It's much more easy to get in and out, and it's physically backed, and you don't have to worry about storage. And it's much more liquid. And the other important thing is it opened up a universe of institutional investors to gold that couldn't participate before. Pension funds couldn't physically own commodities before, nor could mutual funds, but they can own the GLD, and because it's a exchange traded currency, if you will. And so that's really opened up the world to gold investing. It's much easier to buy gold than it was, 15, 20, 30 years ago. And so that's encouraging. It's much more mainstream than it was.
So in terms of, you're bullish on gold, but you would say that the supply side factors are very small in terms of guiding that bullishness in comparison to the demand side factors. Would that be an accurate statement?
Yeah, though I think what it does is it does improve the sentiment. To be able to talk to you about peak mine supply, we've achieved that, and we've seen reserves decline. It certainly feeds the sentiment, the positive sentiment. Does it really drive the price? Gold doesn't really trade on demand supply fundamentals like commodities like copper, for example, where there's a big structural deficit there, and that's clearly going to be driving copper for a long time. Gold is a demand-driven market primarily, but it's nice to have that kind of sentiment, speak to the kind of sentiment that supply constraints speak to in the gold sector right now.
One of the things the mining industry would not be known for would be its environmental issues or credentials, rather. What can the mining industry do to appease the green argument or environmentalists? Or can they? Is it possible?
No, I think it is. And I think with a lot of the metals, they're actually quite important to decarbonizing the economy. For example, copper, if we're looking at electrified vehicles, there's 3 times the amount of copper in an electric vehicle than there is in a traditional internal combustion engine. We need copper. We need copper to electrify the economies and continue to urbanize rural populations in the developing world. And we've demonstrated that it's much less carbon intensive to live in a more a denser population with an urban environment. So it really drives carbon intensity down to start to concentrate populations. And to do that, though, we need to electrify. We need to invest significantly in copper supply in order to urbanize the global economy and continue that drive. And so we need copper, for example. So I think the necessity of copper, rare earths, and whatnot are very, very important to decarbonize and continue to decarbonize the economy. So I think mining gets a bad rap in that regard, but it's an existential necessity for the global economy and for achieving net zero emissions by 2050 for the mining industry to be very successful and actually increase supply dramatically, particularly on things like copper. So I think we need to tell that story a lot more effectively. I also think that at the mine site, we're doing a much better job of dealing with carbon intensity. When I was running GoldCorp, for example, we built the first all-electric underground mine in Northern Ontario called Borden Lake. Okay. And so that's a zero-emission mine site. Now that's a relatively small underground mine at 1,800 tons of ore per day, but that equipment that Sandvik built for us is rapidly being scaled. And I think in time, we're going to see a carbon intensity come down dramatically at mine sites as a result. The area that we need to focus on that I don't think we have a very good track record on is actually on water consumption.
Right.
We need to become net zero water consumers of water. We're not there yet. We still don't recycle enough of our water. And wars are fought over water. And quite often, the reason we have a difficulty getting a social license to build new mines in certain regions is the lack of water, scarcity of water, perceived scarcity of water. And if we don't do a more effective job of actually driving down our water consumption, we're going to have a difficult time building up new capacity to meet the world's demands, whether it's on the gold or the base metal side. And the biggest consumer of water in the value creation chain within the mine site is in our tailings facilities. So where all of our waste is dumped, there's a lot of water that's consumed in that. Mm-hmm. We build tailings impoundments, big dams, and sometimes, it doesn't happen often, but sometimes those dams break, they breach, and it causes a lot of environmental damage and damage to people. And it sometimes kill people. It's extremely rare. It's kind of like the airline industry. It rarely happens, but when plane crashes happen, they're always catastrophic. It's the same thing with these facilities. We need to get out of the traditional tailings facility construction business. We need to go to better technologies like dry stack tailings, which effectively dehydrates our tailings, creates inert bales of tailings, which can't spill. They're just stacked like bales of hay, and drives down our water consumption, increases our recycling rates dramatically. So it is a bit of a virtuous cycle. We need to adapt that technology and scale it more quickly and get out of traditional tailings construction. I think that would largely deal with the environmental concerns around new mine construction and really enhance our social license to operate.
While we're on the idea of environmental, and you touched on the renewable energy aspect when it comes to copper and the use in electric cars, I want to circle back to silver for a second, because obviously there's fantastic applications for silver in the solar, in the renewable energies market, as well as in the medical devices and applications market. Now, you talked about silver. When you talked about silver, you talked about it as a proxy for gold and as a quasi-monetary metal. And I assume, first of all, that you're as a result, you're bullish on silver, one, but how much of that bullishness is as the monetary aspect or the proxy for gold, or is there an element of that, a large element of that has this renewable energies story to it?
Absolutely. I do think there's a strong case to be made for demand supply fundamentals on silver, but I think the potential for investment demand as a proxy for gold would dwarf that. And I'll give you a quantitative example. If you believed in my thesis that gold's going to $3,000 an ounce in this cycle based on previous cyclical highs, and we saw a narrowing of the ratio of gold to silver to more traditional 30 to or 40 to 1 that we've seen in the last bull markets, silver would easily go through $100 an ounce if gold went to $3,000 an ounce. So, and we're in the mid 20s right now. So you can see the type of potential appreciation you could see in silver and potential leverage the precious metal recoveries or precious metal rallies that silver provides.
Just to finish up, David, talk to me a bit about Gold Royalty.
Sure. So Gold Royalty Corp is a company we IPO'd a couple of months ago in March, actually. We raised $90 million US on the New York Stock Exchange. And we did that with a mineral endowment of 26 million ounces or 31 million ounces on a gold equivalent basis underpinning our royalty portfolio. We have 18 royalties currently. And we're going to use that treasury to continue to diversify and grow our royalty base. The beauty of the royalty business, as I see it, is it gives you full leverage to the gold price because we take a fixed percentage of the top line of the revenue. And we get leverage to the exploration success because our royalties are adhered to the underlying properties. So if the operators are successful and continue to grow their deposits geologically, we participate in that upside. So really, it's the best of all worlds. It's like owning an ETF with exploration upside because we're not exposed to operating costs or capital cost risk at all. We don't care about the margins of the mines. If their cost structures inflate, as I'm theorizing they will, we don't get exposed to that. So it really does provide you the best of all worlds, full leverage to the gold price exploration without the underlying risk associated with running an operation.
And how can our community find out more about what it is that you do?
Well, it's easy to remember. We're goldroyalty.com. I was shocked when we were able to protect that name. And we're GROY on the New York Stock Exchange, GROY. And
in terms of following you, where are you active? You active on social media?
I have a LinkedIn profile, but I otherwise social media non-conversant. But you can find me on LinkedIn, and there's a LinkedIn profile for the company as well.
Superb. What I'll do is I'll put the LinkedIn profile for the company in the show notes below this video, and we'll also put the link to your website as well. But David, thank you for joining us on GoldCore TV today.
Thanks, Steve.
Thanks for watching. You can catch more interviews with industry experts and thought leaders in financial markets by subscribing to GoldCore TV. So go and do that now. And if you want to learn more about how you can invest and store physical gold and silver, visit goldcore.com, your precious metals specialists.